Ladies and gentlemen of the crypto space, we're live at 11:42 a.m. on a Wednesday, April 7th. It's time to get the party started. We got a nice topic today. Had some inspiration from some Noah's office hours, and it's a very important topic because it's the reality that we live with. We have our portfolio. I tell everyone, play your portfolio. You have to play the cards you're dealt with, and you can't compare your portfolio to other person's portfolios. It's just pointless. You can draw inspiration from other portfolios to get ideology, strategy, methodology, so on and so forth. But play your hand. It's like poker. You're not playing someone else's hand, but you have to be respective of it, and you're reacting to it. But you're basically playing your hand. That's the name of the game. Got to play the cards you're dealt. Portfolio size and realistic, risk-considerate choices. So we're going to talk a bit today about my prevailing ideology. Obviously, a lot of my sentiment, my enthusiasm, and what I talk about is respective of the size of my portfolio. But I also need to talk about other realities. Everyone has their own reality, and I need to broaden the scope of what I talk about to be able to provide advice to a broader array of persons, respective of their size portfolios. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social good. Stop depositing on exchanges, not your keys, not your crypto, non-custodial DeFi, or nothing at all. Bam, let's pop it over to the main screen and see who's in the stream. Got Montana's in the house, Crypto Yogi, always a pleasure. Pellets, my man. Inspirational, drawing the inspiration for this stream from our conversation. Matt, my man, UK in the house. Wave, good day, peace, love, and joy, or some fancy thing like that. 10 people in the stream, 6 likes. We are doing better. Good stuff. We got CoinGecko up on the screen. Markets took a nice hit this morning. What's most pertinent, or what I would say is a great way to get an aggregate sense of where we are in the markets, is Bitcoin. Bitcoin's down a respectable 2.3%, relatively muted as compared to all coins taking sometimes fat dips. Let's sort it like that. Double-digit percent losses on lots of assets. Phil, 16%. Sia Coin 10%. It's been hot lately. UMA 8.9. Some decent hits. This is not a massive hit to the market like we know the crypto space is capable of executing. It's a relatively muted dip. Let's take a look real quick at headlines. Let's see how equities markets are doing. They're probably taking a hit too. I heard they were red. But look, they're at record highs. Everything's inflated. Yeah, probably about horizontal, more or less. Um, let's close that. Let's go over here. That's XTK. We'll get back to that in a second. I want to hit the DXY and get a sense of where markets are. All right, we breached below the 100 SMA in the 4 hour, but obviously there's some support. Stoke is oversold. RSI is bottomed and perking up. Rounding bottom on the MACD, and we're above the 200 EMA on the 4 hour. Let's pop out to the daily. All right, so there's your war right here. So we got the 200 SMA and obviously 200 EMA resistance above head. So it's a fat dip below. 7 hours left on the candle. Where this candle body closes is extremely relevant. Stoke being oversold means that there's sellers are exhausted in many regards, albeit the RSI is midfield. So Stoke, gives you an insight on velocity of movement, but we can have some serious downward pressure on the DXY index, specifically considering Stoke is still midfield. And we do have a bearish cross of the MACD, and this is on the daily. Um, the next couple of candles are going to be quite meaningful. If the 200 SMA proves to be significant resistance to the upside, we could push through these guppies to the downside, and we'll hit the 50 SMA, which is relatively weak long-term moving average, and we could have a velocitization of risk assets, which is what we deal with in the crypto space. Let's go back to Bitcoin for a second. So Bitcoin is still on trend, and that's the most important thing from a macro perspective that I like to think about. That's really tells you where it really tells you where you are in the cycle of the entire markets. If Bitcoin is bullish, the whole market's going to take a dip, but it's going to maintain bullish momentum. Bitcoin starts, you know, correcting significantly with a trend violation, like a mean regression to a 200 EMA on the daily, the whole market's going to take a fat 20-30% dip to the downside. Albeit if there was a full mean regression on a daily to the 200 EMA, that'd be about a 33% dip on Bitcoin. Oh, that'll cause an implosion in the altcoin space. And this is where my strategy and my ideology that I purvey um, to be risk considerate, especially when the market's bullish, because the market turns bearish and you're not going to be able to take action when it does. And this comes in the complexities of portfolio sizes. With a larger portfolio, you could have a significant portion of the portfolio allocated to yield-bearing assets for very risk considerate. You're talking about curve positions, you're talking about dollar-denominated value, but in a bull market, dollar-denominated value is not going to experience significant appreciation. Won't experience asymmetric appreciation, and it's really going to produce yield, which is the whole concept of turning your capital into an employee I always talk about. But with a smaller portfolio, you don't necessarily have the luxury of being able to allocate a healthy amount of capital to that type of those types of allocations. And you do need to make a choice. Do you want to take excess risk or take very little risk at all? If you're going to generate a meaningful amount of monthly income, you need a fair amount of dollars, even at 30, 40, 50%. You put 20 grand into Curve at 30%, you're talking about 6 grand a year in income, and that's not something most of the major countries around the world you'd be able to live on. Many countries around the world you can live on 6 grand, and many countries around the world 6 grand is an impossible yearly salary. But if you have a 20 grand portfolio, that would be the entirety of your portfolio. So many persons with smaller portfolios with a 20 grand portfolio, you're not capable of allocating that unless you're entirely risk off, and then you're taking in not necessarily a quantity of yearly income that you want to. You're in the crypto space for opportunity, and 6 grand a year income is not necessarily the most exciting of opportunities. So there comes a point with the size of the portfolio that you're kind of forced to take excess risk. And I could appreciate this. I myself have been in positions like this. And I talk often about being forced to take action against best interests necessarily, especially with regard to the dollar. The dollar, being in a bank, is being debased at a rate about 15% per year. So we are forced to take on risk. The degree of risk is really the conversation that we're having with ourselves. How much risk are we taking? So with a smaller portfolio, you're kind of forced to have more risk than a person with a larger portfolio that's able to subdivide and take risk with some of their portfolio and little or moderate risk with other parts and no risk with other parts. Um, and that's just a reality we have to deal with. So, the art, I would argue, is with the smaller portfolio, is hopefully younger persons that have time. And time makes a huge amount of difference, especially because time will allow the crypto markets to fulfill what everyone hopes is our vision for them, which is extraordinary growth, global adoption, and inflation to a state that would make the current state of inflation seem relatively trivial. Let's go through the stream. Pellis, my man, it was an honor too. It's a pleasure. You've been with me a long time. Frank Toscano, always a pleasure. Heirloom in the house. Wave. Used 1 inch for the first time yesterday. Do I need to pay to allow 1 inch to send my USDC everywhere? Same with allowing Chi. So Chi, you buy Chi on 1 inch. You could buy it in a couple places probably, but Chi 1 inch has it. Sometimes the liquidity is pretty poor, depending on Gwei and gas prices. Um, the other day I saw Gwei at like 100, and Chi was had horrible liquidity. So I was surprising to see, and unfortunately, it was like 20% slippage to buy some chi. But with chi in your bank, obviously it takes gas to buy it. It's unfortunate reality. But if you have chi in your account and you activate chi on 1 inch, you're talking about like 50% plus gas price savings. So it makes a massive difference. And 1 inch just maximizes the crap out of your swap conversion rate. You get a much better trade on 1 inch than you do any other AMM. Bear in mind, 1 inch goes through every AMM. So you don't need to trade on Bancor to you don't need to trade directly on Bancor to actually use Bancor. If the best trade calculated by 1 inch is Bancor, you're going to be trading on Bancor vis-a-vis 1 inch. And quite often that is the case. Link and a variety of other assets are easily going to go through Bancor. So, and same with Uniswap or any other AMM balancer. And there's like 15 plus AMMs that 1 inch aggregates at this point. 1 inch is really the premier place to make trades. You're going to go through 0x if it's the best trade, albeit Maka is very nice. So it has definitely a place in the market. The awesomeness of 1 inch is no discredit to the potential for Maka in the coming years. Sam says, what is a small portfolio in your view? It's not for me to mention, it's for people to make that assessment unto themselves. For instance, if you have a $10,000 portfolio and you put all of it in dollar stablecoins into Curve and you get 40% on your money and you get $4,000 a year, is that good? If you're living in an inflation-ridden country where debasement is destroying the value of your money, not picking, not being mean or anything, but let's say Argentina. You have 10,000 US dollars and you're making 4,000 extra US dollars per year in a relatively risk minimized position. A person will be able to make an assessment. Does that change everything? Is that a great allocation of value? And many would argue yes. But then also many would argue that 10,000 properly balanced between uh, Bitcoin, Ethereum, and other incredibly existential and systemic components that are emerging in the DeFi space could be the opportunity of a lifetime. Um, Aave, Uniswap, we Curve, Bancor. I mean, these assets have monetary velocity that are the monetary velocity in these assets are actually doing better than your country, your sovereign country, often, which is a crazy reality, and that's what's occurring. These monetary assets have created fiat in many regards with their token issuance and they have monetary policy, inflation, deflation. So it's really a fiat manifestation. So that's the deal. Or better, what size makes sense to apply your risk management strategies? So a lot of what I talk about is my risk management strategies for myself, and which is respective of my portfolio. And which is why I talk about it because it's on my mind. It's strategies and trades that I'm executing, which is exactly why I'm capable of talking about it to the extent that I do. But what everyone needs to do that follows me on the stream or we end up talking in Noah's office hours is develop their own strategy. You can hear my strategy as much as I talk about it, but you have to have a strategy that's respectful of your portfolio. And I will talk about any portfolio size. There's always choices and options, and I've been there. I took excessive risk last year in 2020. I was 40% in Kyber Network, 40% in synthetics, and I was ripping 2, 3, 400% on each one of those. In hindsight, woof, that's like man, that's like looking back and the only sentiment I could possibly have is I'm thankful that I was able to get through that experience without taking losses, and it changed everything, making those types of rips and gains on significant portions of the portfolio. With the smaller portfolio, there's a great deal of sentiment and interest and desire to take excessive risk to grow a significant portfolio, which will present to you more optionality. Um, but only each of us individually can make that assessment. If a person is, if someone's listening to me and they're 60 years old and they're close to retirement and they only have 20 grand saved up, you can't take the risk. You really can't. You need that money. You throw it in urine, you get some Armor-Fi insurance, and you make it 40% on your dollars. And that's a yearly income of $8,000 that could make a difference in someone's life. So the amount of risk that everyone takes really is an individual assessment, depending on your life situation, the amount of capital you have. If you're young, you're in college, and you manage to have $20,000, you could take excess risk. Why? Because you're going to graduate, you're going to be able to work, and you're going to be able to accumulate more than $20,000 if you live financially below your means. So you have a capacity and you have the freedom, the optionality to take excess risk, to turn that $20,000 into $200,000 with some lucky bets. And that's exactly the point of today's stream, that everyone's choices with their portfolio is respective of the actual parameters and properties of their portfolio, primarily the amount of capital that they have available to them. White Wolf, my man, always good info. Thank you kindly. Wave, well said, Noah. Great topic. I appreciate it. Matt, will these yields on stablecoins be around for a long time? The yields are going to get diluted. The opportunity occurring in the DeFi space currently is under the radar. Legacy finance doesn't understand, nor they believe, one, it's sustainable, two, they think it's magical fantasy, and they get angry at it, and they're definitely not participating in it. These yields will not be available. Liquidity eventually will flood the system, diluting the yields. The reason they don't understand, and they discredit it, or they are often derogatory towards what's occurring, is because they can't fathom for a second that the yields are a manifestation of a fabricated fiat currency. So these DAO assets, in many regards, are fiat currencies that have been created electronically, that literally have properties of monetary systems historically only created by sovereign countries. There's an inflation, quite often a decaying inflationary curve, and there's deflationary pressures, just like in the real economy, except these are very quantifiable in the DeFi space, uh, incredibly quantifiable. A burn component for Bancor is going to burn X amount of VBNT per day, so it's going to have a mathematically calculable deflationary pressure on the system. So if you actually put numbers, I do it from an anecdotal perspective, but if you put numbers on it, you could calculate the degree of deflation relative to the degree of inflation, and you could gain a sense specifically of any debasement that's occurring on the currency, BNT, a currency. So, I'm leaning heavily towards defining a lot of these assets as currencies, particularly assets that have monetary velocity, monetary policy, emissions, inflation, and deflationary properties. That's the properties of a currency. Crazy, right? So interestingly enough, Bitcoin is not a currency because it has monetary velocity, but that monetary velocity is probably more so in the context of legacy financial systems. But DeFi in itself is a financial system unto itself, and these assets have real monetary velocity. You could lend and borrow assets on Aave. That's velocity. That's the core of monetary velocity. And monetary velocity is the core of an actual financial system. And financial systems are filled with currencies. So these assets that are actually being lent and borrowed and transacted and have inflation and deflation is the very definition of what a currency is. Crazy shit, guys. Pretty cool. Um, 2710. Have a small 30, 40K portfolio, and I've been thinking through these questions the last few days. Great timing. Yeah, you can thank Palace for this one. There was a wonderful conversation this morning, and I'm actually quite thankful for Noah's office hours. So if any of you want one-on-one time with me, you can find the link to office hours on Twitter. And obviously, I'll be posting it from time to time, usually multiple times per day, with some quirky or well thought out commentary. And we could discuss individual portfolios. I'm more than happy to help the best I can. And my point of reference always is talking about risk. And people need to be aware of how much risk they're taking. You can lose money, real hard-earned money, and I'll always advocate for being risk considerate, which is something that I strongly exercise with my own financials. Um, but it's very dependent on age, and that's meaningful, and the size of the portfolio as we're discussing. With I'm 38 years old. I have mortgage, car payments, saving for kids' college, and that's a massive difference than a younger person in college, maybe with a scholarship, maybe with government grants or government subsidies or what have you, that different countries offer. And maybe you even have food covered and lodging part of the institution. So you don't really have any expenses. So you're going to go to school, get an education, graduate with an income. So that's actually a position where you can take the risks. Ethereum goes to $10,000. Maybe you're in school for another 3 to 4 years, and Ethereum goes to $10,000. It crashes to $800. It's a horrible systemic liquidity event. But over the next 3 to 4 years, it goes to $10,000, and you made 500% on your money, and you have 15 grand worth of Ethereum, and you graduate instead of with 15 grand, but 60 grand. So risk can be taken. What's pertinent is time horizon and acceptance and knowing the degree of risk that's being taken and also knowing how to play it, because time horizon is often neglected. When time horizon is neglected, there's fear and emotions being deployed. What you need to do is ignore the emotions and stick to a rigorous trading strategy. If you're young, have no debt, and have basically no bills, and you have years to burn, and you're going to graduate college, for instance, with an income, and you have 20 grand, you could easily risk 30, 40% on Ethereum, but you have to stick to the strategy. The strategy isn't to buy low, sell high, and dare you say the mistake, buy high, sell low. The strategy is to have it and forget that you have it and check back in 4 years if the expectations of the platform uh, emerge. Ethereum may go to 20 grand, and that 8 grand that you allocated is worth a heck of a chunk of change when you graduate. And maybe you happen to have 32 Ethereum. And that 32 Ethereum you could stake when Ethereum 2.0 goes live. And now you have a source of income for life. So there's a lot of different things to consider. Incredible optionality. And that's the complexity. There's so many choices and options that we can consider, and also things that we really need to consider, like risk, that it makes it difficult. And the best thing that could be said is there's no perfect way to do this. There's no right, there's no wrong. And you can't compare it to others, as I've said. Play the hand of cards that you've been dealt, and only in hindsight will you be able to know how well you did and if you could have done better. And it's not to make you feel bad that you could have done better. That's a learning experience. Now you know how to do better next time around when an opportunity presents itself. Hindsight is the only time where you see this stuff. Angelo, hope the best for everyone. Take care, people. Cheers. Cheers, my friend. Sam, it makes perfect sense. Yeah, and thanks for replying. I'm on a risk taking journey as of now, but feel the need to de risk soon. See, what's pertinent is you can be on the risk taking journey now, but you're listening to me, you're hearing my ideology about risk management. You need to accept risk and know that you're taking risk. Admit to yourself you're taking risk, but have your convictions and act accordingly. And if everything works out as expected, if you make that chunk of change, the most important thing is to know how to manage that chunk of change. If you turn 10 grand into 200 grand, which many people have done in the crypto space, you're probably going to want to take like 50 grand of it and earn 40% on it. And you're going to be making 20 grand a year in salary. And that's what you could do today. Obviously, the yields will get diluted, but the point is, you take it once you have a nice chunk of change, you could do different things with different parts of the chunk of change. You could have little risk with some, moderate risk with others, and excessive risk with a small portion of the portfolio, which is what I talk about. If you turn 1% of your portfolio into 10% of your portfolio, it makes a massive difference. But if you got 10 grand and you're talking 1% is $100, and you turn $100 into $1,000, that's nice. Um, that's not really going to change one's life, especially domestically here in the U.S. Things are ridiculously expensive. So that's why persons they encourage themselves to take excess risk, and I can't argue. And as a parent, I would probably tell my child to take that excess risk, especially if they're pre-college or during college. That's the time to experiment and take risks, but you have to know how to have conviction and accept that you are taking a risk and have a rational time horizon. And don't let emotions get in the way of your conviction and time horizon. The emotions are fear, anxiety, and a fear of loss. But do you have anything to lose? If you have 10 grand, you're in college, you have no debt, and you're living on government subsidy or a scholarship, you have nothing to lose, literally nothing to lose, and everything to make. And for my child, that I would say to her, that's the opportune time to take excessive risk. Um, that's the name of the game. Manolis, Ethereum 100K before 2030. I mean, 2030. So I like to think about the future. 2030. We have no idea what's going to be in 2030. The world will be a completely different place. So we could have extraordinary projections and hopes and dreams. We can't even begin to imagine what will be in 2030. And frankly, I think we have difficulty realizing what will probably be in 2025. There's some good speculation about the energy industry between by 2030, but that's based on current trends. We have much more battery utilization and electrification and battery storage, so on and so forth, because we have the foreshadow. And you could probably argue that what's occurring in DeFi is a foreshadow, and people still doubt it though, and that's unfortunate. But I probably could feel comfortable saying what we're seeing is a foreshadow of the evolution of financials. Now, the complexity there is for an evolution to occur, that means a status quo is being deplaced, um, off, yeah, deplaced. Is that the word? It's being disrupted. Um, and with regard to financials, we're talking about entrenched infrastructure at the sovereign level. So that's a difficult one to see displacement occurring. But it doesn't have to be a disruption, and that's why I'm excited about DeFi, because it could occur in parallel, and it doesn't have to disrupt legacy financials. It's operating unto itself as a completely mutually exclusive financial system. So that's what I see playing out. What's interesting, though, is with regard to the energy transformation and the battery storage revolution that's occurring. We could easily see petrochemical fuels and oil as a fuel being disrupted at this point. Um, the oil industry has become the tobacco industry. They're extremely on the defensive. There's nothing clean about it, and it's ancient and it's well positioned to be deprecated and completely displaced. That's that's just what's occurring at this point in time. So when understanding the future, when looking at the future and looking for disruptions, you really got to analyze and consider how likely the status quo implementation is to be disrupted. And that's a complexity about being a futurist. And, value allocation with very long-term time horizons. Um, Pellets, however, you put the line at 0.92 on the dollar, it looks pretty bullish. So I'm thinking about allocating some more cash in the short term, even with a small portfolio. Now here's the deal. With a smaller portfolio, sure, you could take more risk, but what's pertinent is, but especially by listening to me, you have ideas and thoughts about the very nature of risk. And once you accept that you're taking risk, as I said, there's no perfect way to do a portfolio. But at least by hearing my ideology, you have a choice, and that changes everything. Freedom is choice, and if you don't have the education, the financial education, the experience by being exposed to persons to talk about these ideas and concepts, you may not have that choice. So, it makes me profoundly happy to be able to provide choice to people about how to handle risk differently. So, in many regards, I guess I provide a sense of freedom, financial freedom, freedom of choice. Many people don't necessarily know they have choices, but you do. You could operate in dollars. The world runs on dollars, and you can make 40% on your money, which could outperform monetary debasement. And that's a big thing. You can't outperform monetary debasement in the legacy financial system. You're destroyed in a bank account. You're destroyed with bonds. What, you're going to invest in bonds because you think there's going to be a full on liquidity event and the value of the bond is going to skyrocket? What a perversion of the bond, of treasuries. It's perverted. The whole point of treasuries was to have an asset that's yield bearing, interest bearing, backed by the full faith and credit of the U.S. government. Oh, what a perverted system we live in. Um, F 2.0, another coin on Ethereum. No, it's the evolution of the Ethereum network into a proof of stake network. Whatever you have on Ethereum now will be on Ethereum 2.0. Dr. T, like Sam, wondering at what number one should scale into risk on 150, 200, and if one does this, is that while still holding naked BTC or F bags no long term? A session with you looms, my man. And these are the questions that are not answerable the same between people. Everyone will have a different number, a different goal, have different feelings and opinions on risk, naked bags. You know what I'm saying? We've talked about Ethereum. You don't need to hold a naked bag. You could have XTK paired with Ethereum making 300, 400% on your money. Or Ethereum paired with USDC to achieve dollar stabilization in a leveraged position and alpha more V1. Or 1 inch paired with USDC that has been earning 100% of the money at 1 inch for the last month. That farming contract's going to be coming to an end, but you could still pair 1 inch with Ethereum, 1 inch with USDC, or Ethereum with USDC. Anything with USDC is going to have dollar stabilized value. Impermanent loss is coupled with impermanent gains to the downside. So there's so many variables and parameters for us to deal with in trying to figure out what to do with our capital and how to allocate it. There's no perfect way to do it. So all we could continue to have is this debate about choices and freedom. The more choices we have, the more freedom we have. So we'll keep doing this debate and we'll try and make the best choices possible. And then in hindsight, in the future, we'll be able to analyze, did we make good choices or poor? If we made good choices, everyone's happy. If we made poor choices, you pick yourself up and you keep moving and you learn from it. I told my friend Louis Berry, which is obviously an idea that I've had for a long time. The only difference between people is their capacity to get up when they fail. That's the only true measure of a person, in my opinion. Which is obviously doesn't matter what country you're from, your nationality, your ethnicity, doesn't mean anything. And that's really how I judge people. When you fail, you get up, you push on. Your unending desire and burn for a need to succeed, your drive for success, that's the measure of a person. Lewis, YLA, what an asset. YLA is so cool. Now, the whole thing is I had YLA because I was earning CVP, incentivized returns. I have a small CRV position that I've retained, CVP. But I wanted the CRV emissions directly from Curve because I'm bullish on Curve. So YLA is obviously a derivative of Yearn vaults, and the Yearn vaults are a derivative of Curve LP positions. Yearn vaults take the Curve emissions and compound them, so the Yearn vaults are growing in dollar value, and YLA basically aggregates the compounding dollar-denominated Yearn vaults into a single token. YLA is probably one of the coolest derivative assets. So it's not applicable necessarily to my current strategy and what I want exposure to, but sure as heck, that is an incredible derivative asset. So Power Index, you got DPI and you got a bunch of other index protocols, but Power Index is some of my favorite smart contracts. The nice thing about it is that it tax advantage because it's a stablecoin index asset appreciating. So you can do long-term taxes instead of annual income stream being taxed every year. So that you make a good point because YLA is an auto compounding dollar dominated position, but the amount of YLA you have stays constant. So you're going to experience no capital gains until you liquidate. And you're absolutely right from a tax perspective because if you hold YLA for a year and you earn 30% interest for that year, when you sell your 10 YLA, let's say, you're going to get 30% more USDC. And because you held it for greater than a year, you can literally pay long term capital gains tax on 1 year of 30% interest on dollars. So there's a great tax advantage to these types of instruments. Whereas with, if let's say a bank account was paying 30%, you're getting interest payments yearly. So you're literally paying short-term capital gains tax on those interest payments. And these types of instruments in the crypto space facilitate a significant tax advantage. AG, do all the risk-reduced crypto trading you mentioned recommend include? Yes. Here's the bottom line: if you're not earning interest, um, you're missing out. So if you're holding Ethereum, you should be getting at least 5% interest on your Ethereum. If you're holding any asset, I mean, the Bancor pools, I know they're expensive, the smart contracts, so you do have to weigh your risk versus expense, your reward versus expense. The curve pools are expensive as well. The Yearn pools are quite efficient. So if you got dollars or Link or Ethereum, or WBTC, you could at least get some interest directly from the Yearn pools, the Yearn vaults. So you need to rethink. You need to get yield. If you're not getting yield, that's the biggest part of understanding how to manage money. Because when you make 200 grand, what are you going to sell it for dollars? And then you have nothing. You have to learn how to make your money work and produce a revenue stream. Even if you have a small portfolio, you have to experiment with it, particularly because if you ever turn 10 grand into 250 grand, you don't want to sell your assets, but you sure as hell want to make a weekly salary from your capital. And that's what we all have to learn how to do. Igor, thank you kindly, my friend. StakeNet. So, StakeNet, obviously, the price action has been nothing exciting whatsoever. But I myself have had a StakeNet masternode for years at this point, and it's worth mentioning. It's obviously speculative, but I'm an engineer by education and trade, so the technology I understand and I appreciate, and that's what I've had. It's a trivial amount of the portfolio, the StakeNet masternode, and I bought it at a fraction of the price that it's currently at. So that's just worth mentioning. I think there's much potential for UTXO atomic swap based DeFi. And obviously, BlockNet falls into that category as well. StakeNet and Firo are on my mind. This will become a much bigger show, Noah. You're great at it, and what is discussed here has massive value. Thank you, Sam. I really appreciate it. I'm trying, and I want to make a difference. Obviously, it's lucrative. I want out of my current employment. I'm a software engineer. I work for corporations and develop Android applications for them. But it's time for me to move on to a new practice, and I want to help people make better financial decisions. And what I noticed was there's a complete absence of any financial education with regard to crypto, and probably just broadly from that where someone is passionate. That does it for themselves. A financial advisor dealing with securities and the stock market, snooze fest. That's boring. You can imagine, as I tweeted the other day, going to your financial advisor saying you want to take Bitcoin and collateralize it on MakerDAO so you can get 40% interest on 30% of your Bitcoin using Curve. And any financial advisor is going to have zero experience whatsoever. Now, that's exactly what I could provide: clarity, explanation, technical details, risk consideration, so on and so forth about. And I hope it helps. That's really what I'm trying to do. I'm trying to help, and that makes me happy. Thank you, Lewis. This is all over my head. So YLA is an asset. I found Power Index. That's right, Killis. Found Power Index. YLA is an asset. Uh, it's. I would have to have. I'm not going to do it in this show, but I could go over Power Index again. It's a bit of a sophisticated uh, deployment of capital as compared to just buying something on Uniswap or One Inch Exchange. But basically, you put dollars in, you get YLA, and YLA is earning about 30-40% per year, dollar denominated. And there's risks associated with the position because it involves three levels of smart contracts. But I would argue Curve is de-risked, Yearn is de-risked, and Power Index has proven itself in some regard. And this is where insurance comes in. You're able to have insurance on your Curve position, insurance on your Yearn position. You're not able to have insurance on your Power Index position yet. So these are all important to discuss. And for myself, I'd feel very comfortable allocating 10%, 5% of the portfolio dollar denominated to YLA if market conditions warranted it for me and my portfolio. For myself, market conditions say I go directly to Curve. YLA goes to Yearn, goes to Curve. So I'm bypassing the three and going directly to Curve because I want those Curve emissions. Because I think Curve is the backbone of the DeFi space. Anyway, this has been a wonderful stream. I thank you all for listening to me. One last question. You can use Power Index to zap your USDC to YLA. Exactly. And that is where I was heading with that's not simple. What the heck is a zap? I'm trying to put myself in the shoes of persons that don't have any DeFi experience, and we're going to have more and more such persons over the years. What is a zap? A zap is basically an automation. Getting into YLA without Zap would be complicated. But Zap, right in the Power Index user interface, will allow you to put USDC in and get YLA out. So Zap has simplified the process of converting dollars into basically interest bearing dollars. Love that YLA contract. It's incredible. Lowest power index will swap that day for YLA. It won't pay again for that. So that day is pertinent because power index always swaps every 24 hours. They aggregate and they spread out the gas cost, so it's a reduced cost transaction because it's crowdsourced or communalized, so to speak. Uh, you're welcome, Killis. And Lewis helped much with answering the question. So here you got a little community action. I can't do it all myself. I need everyone on the stream. We're all kicking in a little bit to make a difference. All right, 12:25 p.m. on a Wednesday, April 7th. 40 people in the stream, 23 likes. We can do just a little bit better. As always, I thank everyone very much for joining me. We're going to do it again tomorrow, and I wish everyone a wonderful day. Peace.